Why are there not more people talking about the eerie similarities between today's financial world and the chaos of 1929? Imagine the world at the height of the Roaring Twenties. Jazz music pulses through the air, flappers twirl beneath glittering chandeliers, and the city never seems to sleep. The economy is booming, fortunes are made overnight, and optimism is the currency of the day. But beneath the surface, a different story is unfolding. A story of unchecked speculation, risky investments, and a financial system teetering on the edge. The crash of 1929 was not just a moment in time. It was a seismic event that shattered lives and reshaped the world. Overnight, the exuberance of the decade gave way to fear and uncertainty. Breadlines stretched for blocks, families lost their homes, and the American dream seemed to slip through the nation's fingers. The echoes of that disaster still reverberate today, haunting our financial system like a restless spirit. Today, as we navigate a world of high-speed trading, complex financial instruments, and global markets, the question remains: are we doomed to repeat the mistakes of the past, or can we learn from the ghost of 1929? Is history repeating itself, or merely rhyming in new and unexpected ways? Join us as we unravel the mysteries of a haunted economy and search for answers in the shadows of history. The Roaring Twenties were a decade of dazzling optimism and unprecedented economic growth. Across America, the mood was electric. Jazz music echoed from speakeasies, city lights burned late into the night, and the promise of a brighter tomorrow seemed almost guaranteed. The nation was riding a wave of innovation. Automobiles rolled off assembly lines, radios brought news and entertainment into every home, and skyscrapers began to redefine city skylines. For many, it felt as if the American dream was not just possible, but inevitable. The stock market became the ultimate symbol of this newfound prosperity. Ordinary people, not just seasoned financiers, began investing in stocks, often with borrowed money. Margin buying, where investors put down a fraction of a stock's price and borrowed the rest, became wildly popular. This easy access to credit fueled a speculative frenzy, as people believed the market could only go up. Newspapers ran stories of secretaries and shoeshine boys making fortunes overnight, and the idea of getting rich quick gripped the public imagination. Yet beneath this glittering surface, the foundations were dangerously unstable. Many companies' stock prices soared far beyond their actual value, driven by hype rather than profits. Banks, eager to cash in, lent money freely, often with little regard for risk. Warning signs, like slowing industrial production and rising consumer debt, were largely ignored. The government, too, took a hands-off approach, believing the market could regulate itself. Then, in late October 1929, the illusion shattered. On October 24th, Black Thursday, panic selling began. By October 29th, known as Black Tuesday, the market collapsed completely. In a matter of days, billions of dollars in wealth evaporated. Margin calls forced investors to sell at any price, accelerating the downward spiral. Banks that had lent recklessly now faced insolvency as loans went unpaid, and depositors rushed to withdraw their savings. The consequences were immediate and devastating. Fortunes vanished overnight, and the myth of endless prosperity was exposed as a fragile illusion built on debt and speculation. The crash sent shockwaves through every corner of society. Businesses failed, unemployment soared, and families lost their homes and life savings. The psychological impact was just as severe. People who had felt invincible now faced a future filled with uncertainty and fear. The lesson of 1929 is stark and enduring. Markets are not always rational, and the distance between euphoria and despair can be terrifyingly short. What appears to be a golden age can unravel in days, leaving devastation in its wake. The forces that drove the boom and bust, greed, easy money, and herd mentality, are timeless. Even today, these same emotions and behaviors shape our financial world, reminding us that the lessons of history are never far behind. The story of 1929 is not just about numbers and charts. It is a cautionary tale about human nature, risk, and the fragile line between prosperity and panic. As we move forward, keep in mind how quickly fortunes can change and how the echoes of 1929 continue to influence our understanding of financial risk. In the next chapter, we'll explore how the aftermath of the crash reshaped not only the economy, but also the very fabric of society, setting the stage for the challenges and reforms that would follow. Nearly a century separates us from the infamous crash of 1929, yet the echoes of that era are unmistakable in today's financial landscape. Back then, radio was the cutting-edge technology, fueling a sense of connection and excitement as millions tuned in for the latest market news. Today, artificial intelligence and algorithmic trading have taken center stage, with real-time data and predictive analytics driving decisions at lightning speed. In the 1920s, margin trading allowed everyday people to borrow heavily and speculate on stocks, often with little understanding of the risks. Now, zero-commission trading apps like Robinhood have democratized access to the markets, making it easier than ever for anyone with a smartphone to buy and sell with a swipe, sometimes with borrowed money, thanks to margin accounts and options trading. The result? A speculative mania that rivals the Roaring Twenties. In both eras, stories of overnight fortunes and relentless market gains dominate headlines, drawing in new waves of investors eager not to miss out. Social media amplifies the frenzy, much like newspapers and radio did in the past, spreading hype and fueling FOMO, fear of missing out, on a global scale. Just as in 1929, today's financial markets often seem detached from economic reality. Back then, stock prices soared far beyond the actual earnings of companies, propped up by easy credit, and a belief that the good times would never end. Now, we see similar patterns. The Federal Reserve's low interest rates and quantitative easing have flooded the system with cheap money, inflating asset prices and encouraging risk-taking. Companies with little or no profit, sometimes not even a clear path to profitability, are valued in the billions, based on little more than a compelling narrative or a viral trend. Consider the meteoric rise of speculative assets like meme stocks, cryptocurrencies, and NFTs. In the 1920s, investors poured money into radio companies and automobile startups, many of which would later collapse. Today, we see similar speculative surges in companies like GameStop and AMC, or in digital assets whose value is driven more by hype than by fundamentals. Venture capital chases the next big thing, often prioritizing growth and buzz over sustainable profits. The game of musical chairs continues, with investors hoping to cash out before the music stops. In 1929, when confidence finally cracked, panic selling triggered a devastating crash. Today, the same risks loom. If optimism fades or credit tightens, the consequences could be swift and severe. The lessons of history are clear. When markets are driven by speculation and stories rather than substance, the fallout can be catastrophic. When most people think of the 1929 stock market crash, they picture a single, dramatic event, a day when fortunes vanished and panic swept through Wall Street. But the truth is far more complex. The crash itself was not the root cause of the Great Depression. Rather, it was the most visible symptom of a much deeper systemic malaise that had been festering for years. To understand why, we need to look beneath the surface of the Roaring Twenties, a decade often romanticized for its prosperity and innovation, but one that was also riddled with economic imbalances and dangerous excesses. During the 1920s, wealth became increasingly concentrated in the hands of a small elite. The richest 0.1% of Americans controlled as much wealth as the bottom 42%. While the upper class enjoyed unprecedented luxury, the majority of Americans saw little improvement in their standard of living. Wages for most workers stagnated, even as corporate profits soared. This growing inequality meant that the economic boom was built on a narrow base, with millions left behind and unable to participate fully in the consumer economy. The apparent prosperity of the era was largely an illusion, propped up by easy credit and a culture of borrowing. Americans bought homes, cars, radios, and stocks on installment plans, often with little money down. By 1929, consumer debt had reached record levels. The financial system itself was dangerously over-leveraged, with banks and investors speculating wildly in the stock market using borrowed funds. This speculative frenzy drove stock prices far beyond their real value, creating a bubble that was destined to burst. These underlying problems, soaring debt, rampant speculation, and deep inequality, were the true causes of the economic collapse. The crash was simply the moment when the facade crumbled and the underlying weaknesses were exposed. In many ways, the situation today is eerily similar. Global debt has reached unprecedented heights, and the gap between rich and poor continues to widen, both within countries and across the world. Today, we place our faith in central banks and policymakers to manage these risks, using tools like interest rates and quantitative easing to keep the system afloat. But just as in the 1920s, there are warning signs: asset bubbles, record household debt, and a sense of complacency that the good times will never end. History shows us that these imbalances cannot be ignored forever. The lesson of 1929 is clear. The crash was not the disease, but the symptom. The real danger lies in the unchecked excesses and structural flaws that build up over time. When these are ignored, the reckoning, when it comes, is all the more severe. Economic gravity cannot be defied forever. Eventually, reality asserts itself, demanding a painful but necessary correction. In the roaring 1920s, debt was the magic elixir that fueled dreams and ambitions. It was the engine of illusion, powering a society eager to believe in endless prosperity. Americans flocked to buy cars, radios, and homes, often on installment plans that promised luxury today, with payment deferred to tomorrow. The streets of New York bustled with optimism, as Wall Street soared to dizzying heights, and the average citizen felt wealthier than ever before. But beneath the surface, this boom was built on borrowed money, a fragile foundation. The illusion was so powerful that few questioned its sustainability. Even as debt levels soared, the promise of perpetual growth kept the party going. Today, we've not only inherited this legacy, but perfected it. Debt is woven into the fabric of modern life. Households juggle credit cards and mortgages, corporations issue bonds to finance expansion, and governments borrow to fund everything from infrastructure to social programs. Financial innovation, from mortgage-backed securities to complex derivatives, has made it easier than ever to borrow and lend. These tools can disguise risk, spreading it across the globe and making it harder to see. But the risk never truly disappears. It simply hides in the shadows, waiting for a moment of weakness. Debt creates a veneer of prosperity, but beneath it lies instability, as we saw in 1929 and again in 2008. The global economy now runs on IOUs, promises to pay that stretch from individuals to entire nations. In the 1920s, when the illusion finally shattered, the consequences were devastating. Banks failed, fortunes vanished, and millions lost their jobs. Today the stakes are even higher, as the web of debt connects every corner of the world. The bill, inevitably, comes due. History warns us that illusions cannot last forever. The question is not if, but when the engine of illusion will sputter, and what price we'll pay when reality returns. In both the Roaring Twenties and today, wealth has become increasingly concentrated at the very top. In the 1920s, just 1% of Americans controlled nearly 40% of the nation's wealth, a staggering figure echoed in our own era, where the top 1% now owns more wealth than the entire middle class combined. For most people, wages barely kept pace with the cost of living. In the 1920s, factory workers often worked long hours for low pay, while today, millions of Americans earn minimum wage or juggle multiple jobs just to make ends meet. As historian Dr. Linda Harris explains, when people can't afford basic necessities, they turn to borrowing. In the 1920s, families pawned their belongings or bought on installment plans. Today, credit card debt in the U.S. has surpassed $1 trillion as households struggle to keep up with rising costs. When the bubble burst in 1929, the middle class was too small and fragile to cushion the blow. Businesses shuttered, families lost their homes, and entire communities were left devastated, a pattern we saw repeat during the 2008 financial crisis, and one that experts warn could happen again. Today's inequality rivals, and in some ways surpasses, that of the 1920s. According to economist Thomas Piketty, the gap between the rich and everyone else is now as wide as it was on the eve of the Great Depression. Corporate profits have soared, but real wages for most workers have barely budged in decades. As the stock market surges and the wealthy grow richer, millions face economic insecurity. Experts warn that such extreme inequality makes our financial system dangerously unstable, just as it did nearly a century ago. Throughout history, central banks have found themselves at the heart of economic storms, tasked with the impossible, balancing stability and growth while avoiding the pitfalls of both inflation and collapse. In the 1920s, the Federal Reserve faced mounting pressure as speculation soared and asset prices detached from reality. Their choices were stark: raise interest rates to cool the frenzy, or keep money cheap and risk fueling an even bigger bubble. When the Fed finally tightened policy in 1928 and 1929, the result was catastrophic. The stock market crashed, banks failed, and the Great Depression followed. This historical lesson haunts central bankers to this day. In modern times, central banks like the Federal Reserve, the European Central Bank, and the Bank of Japan have often chosen the opposite path, keeping interest rates low and injecting liquidity into the system. This approach, especially after the 2008 financial crisis and during the COVID-19 pandemic, was meant to stabilize markets and encourage lending. But these interventions have had unintended consequences. Asset prices, stocks, real estate, and even cryptocurrencies have soared, benefiting the wealthy and widening the gap between rich and poor. Critics argue that easy money policies have created new bubbles and fueled social discontent. Today, central banks face a familiar dilemma. If they tighten monetary policy, raising rates or reducing stimulus, they risk triggering a market panic, as seen in the 2013 taper tantrum or the sharp sell-offs in 2022 when inflation fears spiked. Yet, if they keep money cheap, the risk is that bubbles will continue to inflate, making the eventual correction even more painful. Experts like former Fed Chair Ben Bernanke and economist Nouriel Roubini warn that the longer imbalances persist, the greater the danger of a severe downturn. The stakes are now global. With interconnected markets and economies, decisions made in Washington, Frankfurt, or Tokyo ripple across continents. The central bank dilemma is no longer just a national issue. It's a challenge for the entire world economy, and its outcome will shape the future for generations to come. Speculation is the engine that drives every financial bubble, and at its core lies human psychology, an intricate dance of greed, fear, and the ever-present lure of missing out, or FOMO. When markets surge, optimism becomes contagious. People see their neighbors, friends, and even strangers making fortunes overnight, and the desire to join in becomes irresistible. This collective enthusiasm can quickly morph into a frenzy, where rational analysis is replaced by emotional decision-making. In the 1920s, stories of ordinary people striking it rich on the stock market spread like wildfire. Taxi drivers, teachers, and factory workers all wanted a piece of the action. Today, the tools have changed. Trading apps and social media platforms make it easier than ever for anyone to participate. Viral posts and trending hashtags can send stocks soaring in hours, amplifying the mania and drawing in millions of new speculators. The psychology behind speculation is strikingly similar to gambling. Case in point, the GameStop saga of 2021, where online communities banded together to drive up the price of a struggling retailer's stock. Many participants admitted they were motivated less by company fundamentals and more by the thrill of the chase, the excitement of beating the system, and the hope of a life-changing windfall. This mirrors the 1920s, when investors piled into stocks with little regard for underlying value, swept up by the intoxicating possibility of quick riches. Psychologists call this herd behavior, the tendency for individuals to mimic the actions of a larger group, especially in times of uncertainty. Whether it's the Roaring '20s or the digital age, the technology may have evolved, but the underlying impulses remain unchanged. The tools of speculation are new, but the human mind, with all its hopes, fears, and biases, is timeless. The most important asset in any economy is confidence. It's the invisible glue that holds together the complex web of transactions, investments, and promises that make up our financial system. Without it, even the most robust economies can unravel with astonishing speed. In 1929, trust evaporated overnight, triggering a cascade of panic. As historian Liaquat Ahmed notes, confidence is the cheapest form of capital, but also the most elusive. When people lost faith in banks and markets, the result was a devastating chain reaction: bank runs, plummeting stocks, and a global depression. Today, our system is even more abstract: digital money, complex financial instruments, and a web of global interconnections. Trust is now placed not just in banks, but in algorithms, digital ledgers, and institutions that most people never see. As economist Nouriel Roubini warns, the speed and complexity of modern finance mean that confidence can be lost in seconds, not days. The 2008 crisis showed how quickly confidence can vanish. When Lehman Brothers collapsed, it wasn't just a single bank that failed. It was a shockwave that rippled through the entire global system. Investors, businesses, and ordinary people suddenly questioned the safety of their money. As former Federal Reserve Chair Ben Bernanke reflected, the crisis was, at its core, a crisis of confidence. Once trust is gone, it's almost impossible to restore. We saw this again during the COVID-19 pandemic, when rumors and uncertainty led to panic buying and market volatility. Experts like psychologist Daniel Kahneman emphasize that confidence is built slowly, but can be destroyed in an instant. In a world where information and misinformation spreads at lightning speed, the fragility of modern confidence remains one of our greatest vulnerabilities. In 1929, the world's economies were largely national, with only limited connections across borders. The United States, for example, was a powerhouse of industry and finance, but its economic fate was still seen as mostly separate from Europe or Asia. Trade happened, but it was slow. Goods traveled by ship, information by telegram, and financial shocks took weeks or months to ripple outward. Over the decades, a series of milestones transformed this landscape. The Bretton Woods Agreement in 1944 laid the groundwork for international financial cooperation. The rise of multinational corporations, the oil shocks of the 1970s, and the deregulation of the 1980s all pushed economies closer together. The fall of the Berlin Wall and the opening of China's markets in the 1990s accelerated globalization, while the Internet revolution made information and capital flow at the speed of light. Today, our financial system is instantly global. Markets in New York, London, Tokyo, and Shanghai are linked in real time. A shock in one country can trigger a cascade of reactions around the world within minutes. The concept of contagion, where a crisis in one market spreads rapidly to others, has become a defining feature of our era. The 2008 financial meltdown was a stark demonstration. What began as a housing crisis in the United States quickly spiraled into a global banking emergency, wiping out trillions in wealth and plunging economies worldwide into recession. In 2020, the COVID-19 pandemic froze markets and supply chains everywhere, showing how deeply interconnected and vulnerable the global system has become. The risk is now planetary. In a world where economies, banks, and markets are woven together by technology and trade, a crisis anywhere can become a crisis everywhere. Understanding this shift, from national economies to a truly global system, is essential for navigating the challenges of the 21st century. In the 1920s, leverage was straightforward and visible. Investors would borrow money directly from brokers to buy stocks, often putting down as little as 10% of the purchase price. This meant that a small decline in stock values could wipe out entire fortunes overnight. The risks were clear, and the consequences, though devastating, were easy to trace. Today, leverage is far more complex and often hidden deep within the financial system. Instead of simple margin loans, we now have a vast array of derivatives, options, futures, swaps, and synthetic products, layered on top of one another. These instruments can multiply risk many times over, but their true impact is often obscured by complicated structures and off-balance sheet entities. The 2008 financial crisis exposed just how dangerous this hidden leverage can be. Banks and investors had bundled risky mortgages into mortgage-backed securities, then sliced and repackaged them into collateralized debt obligations, or CDOs. These products were sold around the world, often with little understanding of the underlying risks. When homeowners began to default, the losses cascaded through the system, triggering a global meltdown. Today, the financial system is even more opaque. Many of the most significant risks are hidden in the so-called shadow banking sector, institutions that perform bank-like functions but operate outside traditional regulations. These entities use complex products and off-balance sheet vehicles to take on massive exposures, often without the transparency or oversight that would allow regulators or investors to see the full picture. For example, shadow banks might use credit default swaps, essentially insurance contracts on debt, to make huge bets on the health of companies or countries. These exposures can be many times larger than the actual assets on their books, and because they're traded privately, it's nearly impossible to know who holds what risk until it's too late. The biggest risks in our financial system are often the ones we can't see, hidden behind layers of complexity, buried in off-balance sheet vehicles, or masked by the opacity of shadow banking. As history has shown, These unseen dangers can erupt suddenly, with devastating consequences for markets and economies worldwide. Understanding and monitoring hidden leverage is more critical than ever in today's interconnected world. "This time is different" is the most expensive phrase in finance. But why do we keep falling for it, decade after decade? The answer lies deep within the human mind, where hope, fear, and denial collide. Denial is a powerful psychological defense mechanism. According to Sigmund Freud, denial protects us from uncomfortable truths. In finance, this means ignoring warning signs, both in the Roaring Twenties and today. Psychologists call this the normalcy bias, the tendency to believe that things will continue as they always have, even in the face of mounting evidence to the contrary. Throughout history, denial has blinded investors and policymakers alike. In 1929, experts insisted the stock market had reached a permanently high plateau. In 2008, many believed housing prices could only go up. These are classic cases of confirmation bias, seeking out information that supports our optimism while dismissing anything that challenges it. Warnings about bubbles and debt are often ridiculed or ignored until it's too late. Denial, fueled by psychological biases, always precedes collapse. Recognizing these patterns is the first step to breaking the cycle. The Great Depression was not just an economic catastrophe, it was a seismic event that transformed the political and social landscape of the world. In the United States, the collapse of the financial system led to widespread unemployment, homelessness, and hunger. Breadlines stretched for blocks, and families were uprooted from their homes, forced to migrate in search of work and stability. The government, under President Franklin D. Roosevelt, responded with sweeping reforms known as the New Deal, fundamentally altering the relationship between citizens and the state. Social safety nets like Social Security and unemployment insurance were born out of this crisis, reshaping American society for generations. But the consequences were not limited to the United States. Across Europe, economic devastation fueled the rise of political extremism. In Germany, the collapse of the Weimar Republic paved the way for Adolf Hitler and the Nazi Party, while in Italy, Benito Mussolini's fascists seized power. Economic pain breeds anger, polarization, and a desperate search for scapegoats, conditions that extremists exploit to gain influence. The social fabric frayed as trust in traditional institutions eroded, and radical ideologies took root. Fast forward to today, and we see striking parallels. Economic stagnation, rising inequality, and the erosion of the middle class have fueled a new wave of populism and protest. Movements like the Yellow Vests in France, Occupy Wall Street in the United States, and Brexit in the United Kingdom all reflect deep-seated frustrations with the status quo. Social media amplifies these grievances, allowing anger and polarization to spread faster than ever before. Today's unrest and populism are deeply tied to economic realities, stagnant wages, widening inequality, and a profound loss of trust in political and financial institutions. The fallout from financial crises is always more than economic. They leave deep scars on societies, fueling division, undermining faith in democracy, and sometimes paving the way for authoritarianism. History shows us that when economic pain goes unaddressed, the consequences can be profound and long-lasting, reshaping nations and sometimes the world itself. In the 1930s, the initial policy response to the Great Depression was marked by austerity and a reluctance to intervene aggressively in the economy. President Hoover's administration believed in balanced budgets and limited government action, which only deepened the economic downturn. As unemployment soared and breadlines grew, the government's inaction led to widespread suffering and a prolonged crisis. In contrast, today's policy reactions are swift and interventionist. During the 2008 financial crisis, central banks slashed interest rates and injected trillions into the financial system through quantitative easing. Governments rolled out massive bailouts for banks and major industries, aiming to prevent a total collapse. More recently, in response to the COVID-19 pandemic, unprecedented fiscal stimulus and direct payments to citizens were deployed to cushion the economic blow. While these interventions have prevented immediate disaster, they come with significant side effects. Easy money and bailouts have allowed unprofitable zombie companies to survive, distorting competition and productivity. Asset prices, from stocks to real estate, have soared, creating bubbles that threaten future stability. Cheap credit has fueled risky speculation, making the financial system more fragile. Policymakers now face a difficult dilemma. On one side, the risk of deflation and economic stagnation if support is withdrawn too soon. On the other, the danger of runaway inflation if stimulus continues unchecked. The balance is precarious, and the consequences of missteps can be severe, as seen in the recent surge in global inflation rates. Ultimately, neither the austerity of the past nor the interventionism of today has fully resolved the underlying instability in our economic systems. The challenge remains: how to create policies that foster sustainable growth, address inequality, and prevent future crises, without sowing the seeds of the next disaster. Throughout history, the specter of deflation has haunted economies, especially after the devastation of the Great Depression in the 1930s. Central banks, learning from the painful lessons of that era, have shifted their approach dramatically. Instead of allowing prices to fall and risk economic stagnation, they now actively target a steady, low level of inflation as a permanent policy. This strategy is designed to keep money circulating, encourage spending, and prevent the kind of economic paralysis that gripped the world nearly a century ago. But this policy comes with significant trade-offs. By deliberately allowing prices to rise over time, central banks erode the real value of savings. For ordinary people, this means that money set aside for the future buys less and less each year. At the same time, inflation makes it easier for borrowers, including governments and corporations, to repay their debts with cheaper dollars. This encourages both public and private sectors to take on more debt, fueling economic growth, but also increasing financial risk. The modern era has seen this policy taken to new extremes. In response to the 2008 financial crisis and the 2020 pandemic, central banks unleashed unprecedented waves of money printing, known as quantitative easing. Trillions of dollars, euros, and yen were created to stabilize markets and prop up economies. While these actions prevented immediate collapse, they also set the stage for higher inflation, as more money chased the same amount of goods and services. Today, inflation is not just an economic side effect. It has become a deliberate tool for managing the global financial system. By keeping inflation positive, central banks aim to reduce the real burden of debt and stimulate economic activity. However, this approach also risks undermining trust in money itself, as people watch their purchasing power decline year after year. The challenge now is to balance the benefits of inflation against its long-term costs, as history warns us of the dangers on both sides of the policy divide. Repeated bailouts have taught markets to expect rescue, creating moral hazard. Risk-taking is rewarded, not punished. This phenomenon, known as moral hazard, occurs when entities have an incentive to take on excessive risks because they believe they will be protected from the consequences. Markets are addicted to cheap money, a dependency that has been fueled by years of low interest rates and quantitative easing. This addiction has led to a cycle where financial markets expect continuous support from central banks, panicking at any sign of withdrawal. When central banks signal a tightening of monetary policy, markets react with extreme volatility, fearing the end of easy money. We've traded small failures for the risk of a massive collapse. The 2008 financial crisis is a prime example, where the collapse of Lehman Brothers triggered a global economic meltdown. Experts argue that the moral hazard created by bailouts and easy money policies has led to a fragile financial system. Economist Nouriel Roubini, who predicted the 2008 crisis, warns that the next collapse could be even more severe. Case studies of financial bailouts, such as the rescue of AIG and the Troubled Asset Relief Program, TARP, illustrate how government interventions have prevented immediate disasters but have also set a precedent for future expectations of rescue. The debate continues on how to balance the need for financial stability with the risks of encouraging reckless behavior. Some analysts advocate for stricter regulations and oversight, while others believe in allowing market forces to play out naturally. Educating investors and financial professionals about the dangers of moral hazard and the importance of prudent risk management is crucial. Only by understanding the past can we hope to avoid repeating the same mistakes in the future. In 1929, panic spread by telegraph, with news of the crash traveling from city to city in a matter of hours. Today, information moves at the speed of light. Breaking news, rumors, and market data are transmitted instantly across the globe, reaching millions in seconds. Technology has transformed the way markets react. Algorithms now execute trades in microseconds, responding to news and price changes faster than any human could. Social media platforms like Twitter and Reddit can spark market movements, as seen in the GameStop frenzy of 2021, where a wave of online posts led to a historic short squeeze, catching Wall Street off guard. Flash crashes, sudden severe drops in asset prices, have become a hallmark of our digital age. In 2010, the Dow Jones plunged nearly 1,000 points in minutes, only to recover almost as quickly. These events reveal how interconnected and fragile our financial systems have become, with technology amplifying both risk and volatility. The next panic may not be driven by human emotion alone, but by algorithms acting on data at incomprehensible speeds. As we saw during the 2018 volatility spike, automated trading can trigger massive sell-offs before most investors even realize what's happening. In this new era, technology and speed are the ultimate amplifiers, capable of turning a ripple into a tidal wave and making the system more unpredictable than ever before. History doesn't repeat, but it rhymes. The crash of 1929 stands as a stark warning, but it's not a blueprint for the future. Instead, it's a pattern, a set of recurring themes that echo through the decades, shaping each new crisis in familiar yet distinct ways. The next crisis won't look exactly like 1929, but the patterns, debt, bubbles, denial, are the same. In 1929, unchecked speculation and easy credit fueled a market frenzy. Fast forward to the dot-com bubble, the housing crisis of 2008, or the recent cryptomania, and you'll see the same ingredients: optimism morphing into euphoria, risk dismissed as irrelevant, and warnings drowned out by the roar of easy profits. Human psychology and math don't change. Greed, fear, and the belief that this time is different drive markets to unsustainable heights. The numbers, ratios of debt to income, price to earnings, leverage, eventually assert themselves, regardless of the era or technology. A system where debt outpaces income will always break. In 1929, margin debt soared as investors borrowed to chase rising stocks. In 2008, homeowners and banks piled on leverage, convinced housing prices could only go up. Today, corporate and government debt reach new highs, while incomes struggle to keep pace. The structure becomes fragile, and eventually, the smallest shock can bring the whole system down. The echo of 1929 is a warning. The math always catches up. No matter how much the world changes, the fundamental laws of finance and human behavior remain. Each generation faces its own version of the crisis, but the underlying story is the same. When risk is ignored and debt is allowed to spiral, the consequences are inevitable. The past doesn't repeat, but it offers a rhyme, a cautionary tale for those willing to listen. The Great Depression was a cataclysmic event that shattered faith in unregulated markets and laissez-faire economics. It led to sweeping reforms, including the establishment of safety nets, regulatory frameworks, and central bank backstops, designed to prevent such a disaster from happening again. However, these solutions also introduced new vulnerabilities. The concept of moral hazard emerged, where entities took on excessive risk, believing they would be bailed out. Additionally, the measures sometimes led to inflationary bubbles. The lesson here is that every fix contains the seeds of the next crisis. The very mechanisms designed to stabilize the economy can, over time, create conditions ripe for new forms of instability. There are no perfect solutions, only trade-offs. Policymakers must constantly adapt, learning from past mistakes while remaining vigilant about the unintended consequences of their actions. The real lesson of the Great Depression is the importance of balance, balancing regulation with innovation, safety nets with personal responsibility, and economic growth with financial stability. As we navigate the complexities of today's global economy, we must remember that history is not just a series of events, but a repository of lessons. By understanding the past, we can better prepare for the future. In today's world, prosperity seems to be everywhere. Gleaming cities, record-breaking stock markets, and a culture of consumption that never sleeps. But beneath this glittering surface lies a troubling foundation: debt inequality. The wealth gap has widened dramatically, with much of the apparent growth fueled not by real productivity, but by easy credit and speculative investments. Just as in the roaring 1920s, speculation is rampant. Investors chase quick profits, often ignoring underlying risks. Growth is artificially stimulated by a flood of cheap money, with central banks keeping interest rates low and injecting liquidity into the system. This has led to a surge in asset prices, stocks, real estate, even cryptocurrencies, creating an illusion of endless wealth. Central banks, in their efforts to stabilize economies, have inadvertently inflated bubbles. Asset prices soar far beyond their intrinsic value, while household and corporate debt reach historic highs. Experts warn that this environment is unsustainable. Nobel laureate economists and financial historians alike point to the dangerous disconnect between market exuberance and real economic fundamentals. What we're witnessing is not sustainable wealth, but a fragile illusion. The system is propped up by confidence and credit, vulnerable to shocks. If consumer sentiment falters or interest rates rise, the cracks in this foundation could widen rapidly, leading to cascading failures across markets and households. The warning signs are everywhere: surging inflation, volatile markets, and growing anxiety among ordinary people. Financial experts caution that the question isn't if this illusion will end, but when and how severe the consequences will be. Will we heed the lessons of history, or are we destined to repeat the mistakes of 1929? The ghost of 1929 lives on, in our markets, echoing through every tick of the stock ticker and every anxious glance at the financial news. The lessons of the past are never truly gone. They linger, shaping the very fabric of our economic reality. The crash of 1929 was not just a financial event, but a seismic shift in the collective psyche, a warning etched into the DNA of capitalism itself. Each generation, it seems, must confront its own temptations and excesses, its own belief that this time, things are different. In our policies, our ambitions, and the psychology that drives both, we see the same patterns repeating. We convince ourselves that with new technology and clever strategies, we can outsmart the fundamental laws of economics, believing we are immune to the mistakes of those who came before us. The optimism of the Roaring Twenties, fueled by innovation and speculation, mirrors the exuberance of our own era, where algorithms, cryptocurrencies, and global markets promise endless growth. But history whispers caution. Every innovation carries risk, and every boom sows the seeds of its own undoing. Yet beneath the surface, the foundation remains as fragile as ever, perhaps even more so, as our tools and innovations can amplify both our successes and our failures. Leverage, speculation, and unchecked optimism have not disappeared. They have simply evolved, taking new forms in a digital age. The next fall, if it comes, could be more devastating than anything we've seen before, as interconnected markets and instant communication can turn panic into a global contagion within moments. This isn't a message of doom, but a plea for awareness and humility. History's mirror reflects not just what was, but what could be again. The stories of 1929 and the Great Depression are not relics to be locked away in textbooks. They are living reminders, urging us to question our assumptions and to recognize the warning signs before it's too late. True progress lies not in forgetting the past, but in learning from it, adapting, innovating, and building resilience into our systems and our thinking. The question before us is not whether history will repeat, but whether we will recognize its echoes in time to act. Will we have the courage to truly learn from the past, to challenge the complacency that so often precedes disaster, and to build a future that is not haunted by the ghosts of our own making? Or will we stand by and watch as the ghost of history becomes our reality once more? The choice, as always, is ours. The story of 1929 is not just a chapter in a history book. It's a mirror, reflecting the cycles of hope and hubris that shape our world. From the feverish optimism of the Roaring Twenties to the hard lessons of the Great Depression, and into the uncertainty of today, the same forces, ambition, risk, and the belief in endless growth, continue to echo through time. The question is not whether history will repeat, but whether we will recognize its warnings. The crash of 1929 was not inevitable. It was the result of choices, of ignoring the signs until it was too late. Today, we face new challenges, but the lessons remain. Unchecked speculation, rising inequality, and mounting debt threaten even the strongest economies. Yet, history also offers hope. When we learn, adapt, and act, we can change the outcome. The ghost of 1929 lingers, not to haunt us, but to remind us. Prosperity built on illusion is fragile, but resilience is real. After every fall, communities have rebuilt, reforms have been made, and new opportunities have emerged. Our ability to reflect, to adapt, and to support one another is what drives true progress. So, as we stand at another crossroads, let's not simply listen to the echoes, let's answer them. Let's use the wisdom of the past to build a future that is stable, inclusive, and just. Reflect on the lessons of history, demand accountability, and support each other. Because the story isn't finished, and together, we can write a better next chapter. If this journey has inspired you, subscribe and share. Let's make history, not just remember.